In a significant shift in monetary policy, the Federal Reserve, led by Chair Jerome Powell, has embarked on a new trajectory, one that signals a careful balancing act between combating inflation and supporting a robust labor market. The recent decision to lower the federal funds rate by a half percentage point on September 18 marks the first rate cut since the onset of the COVID-19 pandemic, and it underscores the Fed's evolving strategy in response to changing economic conditions. The Fed's preferred inflation metric, the Personal Consumption Expenditures, PCE price index, has shown a notable slowdown. In August, the PCE price index rose by just 0.1% for the second time in 3 months, and it is expected to have climbed 2.3% from a year earlier. This is the smallest annual gain since early 2021 and is only slightly above the Fed's 2% inflation target. The deceleration in inflation is largely driven by falling energy prices, weaker food costs, and moderating core inflation rates. This easing of inflationary pressures has provided the Fed with the confidence to pivot its policy stance. The core PCE price index, which excludes food and fuel, is expected to have risen 0.2% for a third consecutive month, further reinforcing the notion that inflation is on a sustainable path toward the 2% target. Despite the positive signs on the inflation front, the labor market has shown signs of softening. Job gains have slowed, and the unemployment rate, though still low at 4.2%, has drifted upward over the past year. This dual dynamic of easing inflation and a weakening labor market has prompted the Fed to adjust its policy to avoid a deterioration in employment conditions. Powell's remarks following the rate cut were telling. He emphasized the Fed's commitment to maintaining a strong labor market while advancing toward price stability. The decision to lower rates was not taken lightly. It reflects a careful assessment of the balance of risks and the evolving economic outlook. The Fed's dual mandate, to achieve maximum employment and price stability, remains at the forefront of its policy considerations. The Fed's actions do not occur in a vacuum. Global economic trends and central bank decisions are intricately linked. In Canada, for instance, GDP data for July and a flash estimate for August are expected to show weak growth, potentially below the Bank of Canada's forecast. This could have implications for monetary policy in the region, particularly as the Bank of Canada's governor, Tiff Macklem, prepares to address a banking conference in Toronto. In Australia, the Reserve Bank of Australia is expected to maintain its cash rate target at 4.35%, despite solid labor figures that might have suggested a rate cut was on the horizon. Australian Treasurer Jim Chalmers has indicated that while progress in combating inflation is expected, the central bank may not be ready to cut rates just yet. Across Europe, central banks are also navigating their own economic landscapes. The Swiss National Bank and Sweden's Riksbank are expected to lower borrowing costs, though the magnitude of these cuts is still under debate. The European Central Bank, meanwhile, will be closely watched as its president, Christine Lagarde, and other policymakers address the economic outlook for the region. The Fed's rate cut has significant implications for both consumers and investors. Lower interest rates make borrowing cheaper, which can stimulate consumer spending and business investment. This is good news for consumers as it likely means lower interest rates on mortgages, car loans, and credit cards, making it more affordable to borrow and spend. For businesses, lower rates can encourage expansion and new hiring, potentially boosting economic growth. Investors, too, are likely to view the rate cut positively. Lower borrowing costs can improve the outlook for economic growth and corporate profitability, driving up stock prices and enhancing market sentiment. The Dow Jones Industrial Average's immediate reaction to the rate cut, soaring by as much as 375 points, is a testament to this optimism. In the coming weeks, investors will be parsing remarks from several Fed officials, including Governors Michelle Bowman, Adriana Kugler, and Lisa Cook, as well as regional presidents Raphael Bostic and Austin Goolsbee. These comments will provide valuable insights into the Fed's future policy trajectory and its assessment of the economic outlook. Additionally, a slew of economic data will be released, including August new home sales, second quarter GDP revisions, weekly jobless claims, and August orders for durable goods. These metrics will help gauge the economy's resilience and the impact of the Fed's recent policy adjustments. Internationally, several countries are set to release important economic data. In Japan, the Tokyo Consumer Prices Index is expected to show inflation exceeding the Bank of Japan's 2% target. Malaysia and Singapore are forecast to report slowed price growth in August. China's industrial profit growth will be under scrutiny, as will its medium-term lending facility rate, which is expected to remain unchanged. In Europe, the Purchasing Managers' Indexes for September will provide a snapshot of private sector activity at the end of the third quarter. Germany's IFO Business Confidence Gauge and new forecasts from the country's economic institutes will be closely watched. Given Germany's economic significance within the Eurozone, the Federal Reserve's decision to lower interest rates marks a critical juncture in monetary policy. As the Fed navigates the delicate balance between inflation and employment, it must consider a wide array of economic indicators and global trends. The path forward is not without risks, but the Fed's commitment to achieving its dual mandate is clear. For ordinary viewers and financial professionals alike, this pivot in policy is a reminder that economic management is an ongoing process, one that requires constant vigilance and adaptability. As we move forward, the interplay between interest rates, inflation, and employment will continue to shape the economic landscape, both domestically and globally. In this complex and ever-evolving economic environment, one thing is certain: the Federal Reserve's actions will be closely watched, and their implications will be felt far beyond the borders of the United States. The journey toward achieving a gentle economic landing is fraught with challenges, but with careful policy adjustments and a keen eye on the data, there is hope that the economy can continue to expand while keeping inflation in check.